All right, volatility made a comeback. We had a brief respite from it yesterday, but are right back down to it today. So is today the day that seals the deal, right? Are we now headed towards more of a longer term decline? So I'm going to break down the technicals to see what we should expect to see from there. Continue the conversation that we've had in the previous videos about how to hedge for any extended downward moves, still allowing for the possibility of a bounce, but still putting on some hedges with some decent reward risk ratios to the downside in case there's more to come. So I'm going to break that down. I'm going to break down too what I think drove the selling today. What was the number one reason for this? Obviously, the news is what it was, but why did that drive so much selling? So I'm going to break that down and show you how significant some of these moves in these different asset classes have been. So let's go ahead and get started. Today is Wednesday, August the 14th, 2019. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator here. As you can see, we're back to that bearish combination of a dark pink shading, which means the intermediate line turned back down again, and a dark red line. We're trading below the moving average. We're trading at the lows of last Monday when we came down. Well, not at the lows of last Monday, but at the close. You can see the blue line that I have, the blue Fibonacci lines I've got drawn, represents the Fibonacci retracement zone of the previous intermediate rally that preceded this pullback. The intermediate line's fallen below 50. This is a pullback by virtue of that. And you can see that we are in that area. We break through this area, and now we're into more of a long-term market sentiment pullback. The market sentiment line's falling, but the market sentiment line's not falling, like it fell over here, and this was just an intermediate pullback. Now, it seemed really dire at the time, almost as dire as it seems right now. If I were to redraw these, not this one, if I were to redraw the red lines here, to this peak that we had, you can see that the market sentiment line pulled back to the top of that zone without falling below 50. Once you start getting into the Fibonacci retracement zone, now we're having a market sentiment pullback. And we're obviously not to that point. We're not even to that point. We're not even to the 30. We're just barely testing the 23% Fibonacci retracement zone. So you can see we can pull back down towards 2,800 and still not reach that. In fact, still get to that low point there, and still would be about a 38% retracement, and what could set us up for a move back to the upside, similar to what we saw over here during that intermediate rally, but not intermediate pullback, but not a market sentiment pullback. So that's what we're seeing here. You can see the momentum line obviously falling to extreme lows. That's not surprising considering we closed right on the low of the day today. The near-term line did not. The near-term line fell to the 38th percentile, about where the intermediate line is. That's not a bullish near-term low yet. Now, we follow up tomorrow with a day like today, then that's going to be different, right? That's going to be different in terms of we'll be breaking through the Fibonacci retracement zone. We'll be on the way down to this low point here. And then we'll see if we end up getting a bearish near-term low point, because this is the prior near-term low, and we obviously got a lower near-term high point. If we get a lower near-term low point, now we're on this bearish trend, right? We already had that higher high, and then this was a lower low, lower high, and now potentially a lower low below that. So that's why it's really important how we close at the low of the day today on a pretty extreme day. The range up there says 54 points, but you have to add on the gap from 29.26 to 28.94. So you had about another 32 points of a gap there that's not constituted here. So you add on 32 points, and now we had twice the range as the average. And that average is actually bigger than it has been, as you'll see here in just a minute. And take a look at the Dow Jones Industrial Average. It has gone through the prior low point close, much lower than the S&P, and it's testing the lows. In this case, it would be the lows of last Wednesday, when we got that hammer pattern there. Same pattern, bearish posture. Short-term sentiment line has the potential of forming a bearish low point. Right now, it actually has, because we're already got a lower close, it's actually got the potential for forming a bullish divergence. So keep that in mind there. And then the NASDAQ composite, which has been more bullish here, had a bigger rally yesterday. Same pattern here though. Its near-term line just happens to be higher than the rest, and the momentum line not at zero like the others. And then finally, the Russell 2000, similar to the Dow Jones Industrial Average, breaking down a little bit further below that lower close. And as of right now, depending upon where ultimately this near-term line finishes, would be a bullish divergence with the lower lows corresponding to higher lows on the actual blue line itself down here. So we've had a big move in this past really couple of weeks. But big reversal today of what we saw yesterday, and that's producing an extreme low on the momentum line. It's not producing enough of a low point yet on the near-term line to not look at this as a bullish divergence. And again, it's, you look at the Russell 2000, you go back to the S&P 500, and if I were to go out, a good amount of time here. It's not too often that the intermediate line falls into the lower reversal zone. So that's what, the fact that you get a cluster is rare, and that's what made this so bearish here. But the fact that we get a cluster with the intermediate line being the reversal zone is pretty rare, as you can see. But it's also pretty rare just to get them in the reversal zone. Look at how bearish we were in the beginning of 2018, and that's as low as we got into the reversal zone. Then the follow-up in March, selling, and again, that's as low as we got in the reversal zone on the intermediate line. So it's not too often. It's pretty bearish to get the intermediate line in the reversal zone, and you'll notice we're not anywhere close to it, at least not on the S&P. On the others, we're a little bit closer. On the Russell especially, on the Dow, we're a little bit closer as well. But that kind of puts in context again how bearish we are from a market forecast standpoint. We still don't even have the intermediate line down to a low level to where we've seen in the past that it can get down to. And if it does get down there, and especially as we saw here in the end of May, when it does get down and gets below that 10th percentile, that is about as bullish of a buy signal as you could possibly get. We saw it over here, we saw it again right here, and we'll see if we end up, it's doubtful that we'll get it here anytime soon, unless we really, and I would venture to guess, unless we break through that low point and we get down towards the bottom of this market sentiment retracement, will probably be what it would take to get another intermediate low point below the 10th percentile and set up for that buy signal again. All right, before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over our logo right here in the bottom right corner of your screen, then hit that red subscribe button that pops out. There's also one down below the video if you're watching us on our YouTube page. Also, while you're there, hit the thumbs up icon. That tells us two things. Number one, you got something out of our video today. Number two, that you want us to do it again tomorrow. So a quick way to give us feedback. We look at that every day to see what you're thinking. You can click on that right now while you're watching. Let us know that that you want us to do these videos. Also, while you're down there, comment. What did you get out of the video tonight? Let us know that as well as anybody else coming to the channel for the first time. And checks out the comments to see what the video is about. Let them know what you got out of it down below. Follow or join our Daily Market Outlook email list. We have a link popping out right there in the top right corner of your screen. Click on that link, subscribe to our emails. Follow me on Twitter for more content in between these videos from day to day, and join our Market Outlook community that we've created on Facebook. All right, if you're watching our videos on our website at marketscholars.com, you can see our video posted here. We invite you to engage with us on social media. Click on these Market Outlook tweets and Facebook posts. And the more you engage with us there, the more they'll keep putting our stuff at the top of your timelines. So we try to make it really easy for you to engage. Just click this heart right here. It opens up this window. You can click on that like button. Also click this image that takes you to your Facebook page. You can like today's Market Outlook Facebook posted there again. Again, really easy clicks, and that ensures that Facebook and Twitter puts our content at the top of your timelines instead of getting it buried or even not showing you at all. especially in the case of Facebook. Same thing would apply with LinkedIn. We put all our stuff on LinkedIn. You can like and share our stuff on LinkedIn as well, and they'll continue to put our stuff at the top of your timelines there for those of you that have those accounts. You can see our class schedule coming up. Brandon's Q&A session is tomorrow. We have technical analysis coming up on Friday. That's my technical analysis class that I'll be teaching. Again, you can watch that class. Just click on this link that takes you to our monthly subscription plan, our plus subscription plan. You get a 7-day free trial, so you can watch that class on Friday, and then Brandon's class, dividend growth investing class on Tuesday, as well as see all the archives for that class, for both of those classes as well. If you want any more details on either one of those plans, just go up here to the top menu where it says pricing. All right, back to the charts. As you can see on the long-term view, as bearish as this week has been so far, you can see what the Heikin-Ashi candle looks like compared to last week. So we don't have that lower shadow. You can see when you get, these bearish weeks, you go down, 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 down. We still don't have that for this week. Now, granted, tomorrow's a different story, and we'll see if we end up getting it tomorrow. But that's a good sign. And what it does too is depending upon how we close these next 2 days, the Heikin-Ashi close this week's at, let's see here, where is it at? 2882. 66, 2882.66. We opened up at 2938. That's not going to change, but that puts our midpoint of this week's candle right about 2910. So that's where we'll open up next week. So if we're going to, depending upon how we close, if we are going to bounce at all this week, getting towards 2910 would be a positive sign. Otherwise, we stay down here towards this level, well below 2910, then we're going to have a bearish candle next week as well. What would be the beginnings of a bearish candle next week? Keep in mind that when you say, well, 2910 is pretty far away, it's 70 points away. Well, we are down 85 points today. So in one day, down 3%. One of our bigger losses on the S&P in a while. It's a pretty significant decline. We haven't seen that big. In fact, if we were to go back on this volatility chart here, we did have this big decline of about 2.88%. No, excuse me, 3%. We were 3% down last Monday, so almost another 3% move here today. Back over here during these declines, we had a over 3% move there, and that was about a 3% move. So, the fact that we're getting 3% moves with 2% moves to the upside kind of looks like this again, like we saw in October, and wonder if you might get something like this going. We'll talk about that here more in a second. Let's take a look at the 3 green arrow charts. Of course, we have 3 red arrows now with the stochastics turning back over. If you take a look at the 2-line versions of this chart, here we go, the 2-line version. You see, we tested the 17-day yesterday. And remember yesterday we talked about we have to get above the 17-day to really say, okay, now we're turning around. Just getting to it doesn't do anything. And that's kind of my tweet last week, is like, don't chase that rally because that's not, we're not out of the woods yet. You can see the MACD is still below its moving average. The stochastics, even though it has turned down, is not back below its moving average yet. So keep that in mind. You take a look at the Bollinger Bands for SPY. We are below the point of control, so that's going to put some pressure. The next area of support from a volume standpoint is going to be right here about 280 and a half. There's going to be some significant support in that area, and there's a lot of support down below. So things will really get out of hand to the downside when you break below this 265, the value area here, and we really get going down. That's going to raise itself up as these come off the table and we move over here. But keep in mind that we're not, this, as bad as this seems. In fact, if you look at this zigzag chart here, oops, no, I don't want to delete it. I want to load it. Load the zigzag chart, and then let's change this to look at, say, like a 5% move to the downside. So, we're at a 6%. We're actually still higher slightly, But this is a 6% decline that we're getting right now after a 10% rally. Here we had a 6% decline that was coming off of a 25% rally. So none of these were 5% moves. And you can see, you go back a little bit further, and you can see what some of these, 5% moves to the upside and downside. I mean, we went this whole time without a 5% move. That was over a year, and we tend to get, we had 1, 2, 3, how many last year? 1, 2, 3, 4, 5. We had 5 moves to the downside of 5% or more, with 3 of them getting to 10% or more last calendar year. And that's with 5% or more moves to the upside afterwards. This year we've got 2. So last year 5, this year 2. So that's, keep that in mind. That last year we had 5 because we didn't have any over here. In 2016 we had 2, and close to another one right there during the election, but not quite on the close basis. And then in 2015 we had 2. If I were to go back out a little bit further. To 2014 we had 2. In 2013, during the heart of QE3, we had 1, but then in 2012 we had 2. In 2011 and 2010 is a different story. Look at all those 5% moves to the downside that we had during those 2 years, right? 2010 we had 1, 2, 3, 4, 5, and in 2011 we had 1, 2, 3, 4, 5, 6, 7, 5% moves, and during that decline, including the big credit downgrade of a 17% move to the downside. The biggest one we had over here was a 10% move to the downside, and then go back to last year, and our biggest one was a 16% move to the downside. So is it unreasonable that we got 2 6% declines in a single calendar year? Especially with a 25% move. Again, you look at, some of these moves. We had a 43% move without a 5% decline, and here we had a 23% move without a 5% decline. And over here we had a 27. We had a 27% move without one, and then we got a bunch at that point. So, it's not out of the realm of possibility at all. Coming off of a 10% rally. That coming off of a 25% rally, that we have a little bit of a pullback. So hopefully that gives you a little context as to, I know, and there's a tweet that I've tweeted out from Charlie Biello that says that every time we pull back 5%, it seems like the world's going to end. And he kind of lists all the negative factors for those declines. And the reality is, it does seem like the world's going to end each time, and each time we rally, as you can see, off of these 5% lows, however much, right? Double digits, 8%, 5%, 25%, 14%, 6%, even on the bearish moves, 16%, 12%. We can get these kinds of moves back up to the upside pretty darn easily after these pullbacks, especially when they're, in this case, to higher low points. You can see some of these. We had that decline 10%. We couldn't get a 5% move to a higher high, and that's kind of why we started down here. Here, we did get a 10% move up to a higher high, and as of right now, would be a higher low point. So that's something to keep in mind as well. All right, now let's take a look at today's intraday range. Interestingly enough, again, you can see this little rally. So I talked about that move yesterday. And I said how easy it's been for us to get through this area and to put 287.5 in play. Well, it did it overnight again. So, big gaps, fill in the gaps, big move to the downside, including a gap really quick, big move back to fill it in. And so now we have a gap. And now the question is, are we going to fill that in within the next few days? It took us 1, 2, 3, 4 days over here. But are we going to fill that gap back in? You can see where the volume is. You remember 280.5. Is just right down here. That's where a more significant daily level of volume support is, because if we do, you can see how we filled in come down, then and that's actually my expectations that of what will happen. A lot of volume, then you'll see volatility come back down. We'll bounce off these lows from these extremes. It was hard for us. We might not bounce up to 297 and a half. Pretty decent battle this week, but work our way back up towards it. The Bears won the battle the first time again over the next few days. Definitely within the realm of possibility. The Bears won that battle. But if we break up, the Bears won the battle. VIX takes off tomorrow, and this is the kind of setup that can lead to that. Interestingly, takes off tomorrow and gets up tag right there is still the all-time high. Levels. So then we're going to be bearish for a while. We might not like the head way down to unbelievable lows. In fact, like you can almost 4 standard deviation lows that we saw in late 2018. A little bit outside the 2 we might not do that again because we weren't as that kind of puts also puts into heading into it as we were in October 18. The decline that we have. We have to be able to stomach these types of moves. The difference is. The difference between this type of run, I would say that during these declines here, as you can see on the different investor sentiment surveys, whether it's active investor managers or what do you think? Do you agree or disagree with that assessment? Or there's a link popping out right there in the top right corner of your screen. Click on that hedge fund type. Hit either agree or disagree. If you click disagree, you can see the bullish levels are about, if you can follow my horizontal line, are about as low as they've ever been with our outlook process here today. Here, you can see just how little the bullish levels are. So bulls are really low in number right now. The bulls are. So again, usually that's a pretty decent sign. Especially you can see how bearish the bears are. Again, we haven't been this bearish in consecutive weeks since that low point, these low points right here, or even back here, and those ended up from a maybe not in a few weeks necessarily set the immediate low point, but in terms of a year later, you had a good return off of that. In terms of a year later, you still have, despite this pullback, a really good return off of those low points there. All right, let's go now and take a look at, again, today's range and volume on SPY. So remember, the range here is 8.7 points. This one actually does include the overnight trading, so you can see the high point there. You can see the volume did jump up to more than 1.5 times the average volume, so about 134.5 million shares trading hands. Let's take a look at that, where that's at. 134 million shares is right in this area. That's actually pretty bearish because it's not extreme. And this range at 8 points is really extreme. So keep that in mind. And you can also see, too, the volatility jumped up and got back above 20. But last time we were at 22, when we jumped up to 22, was right about here. Look at where the volatility was in relative to VXV. We were much higher relative to VXV than we are right now. So the VIX isn't nearly as extreme as it was before. So that's a little telling to me too, that we still haven't got to the surge levels, which tells me that this will be a market sentiment pullback. Right? As of right now, we're still just kind of at these extreme levels for volatility, which tells me that we're in intermediate pullback. But the fact that we're still below that 105% means we could definitely get some more volatility. Even if it's just on an intraday basis here tomorrow and Friday, if we ultimately close higher tomorrow, we can still get some volatility through the end of this week because we're not to that. But the benefit, the good thing is that we're also not above 115%, where it would take weeks and a couple of months. Basically, that market sentiment, that orange line falling below 50 before we figure out that low point and finally start working our way back up to the upside. So we're not to that point yet. At least the volatility is not telling us that yet. We are getting some bigger moves. We are getting 3% moves. We saw the trading range was large, but even then, the average, the ATR, the average of that range is working its way up to 1.5%. It's over here. That's kind of the level that we need it to kind of stay below. So we'll see what these ranges are. If we get below 2%, then we are we're going to have more of an extended bearish run. So keep in mind that keep an eye on that now that we're above the 1.5%. Watch that volatility level and see if we ultimately do get a surge on this. If we're really bearish here, if we are in a multi-week, couple of month kind of downward move, then you will see VIX do a much bigger surge than just this. I mean, that was a decent move, 26% move to the upside. The problem is that the back month also moved up, and that's moved up 15%, and that's really when they say the VIX is high, it's time to buy. That's the one that when it gets high, it's time to buy, because that's a long-term outlook of being pretty darn bearish. So keep that in mind there, that if we're really going to be bearish here, watch for a surge of this even more. And it's done that before, so it's not like this is crazy. Getting up to that 30, 35 level, over here it got up to 25 and higher. Watch for it to do that and get up to this 115% level in the next day or two. If it does that, then we're going to be bearish here through September and October. Right? It's going to be volatile during that. There's going to be some ups, but there's going to be more downs, and we're going to be bearish. If this is it, and we've closed in the last little bit 1, 2, 3 times at the highs of the day, and if you go back, and the other times that we've been this bearish, right? There's been other times down here you close at the high of the day, but these don't matter, right? It's when you get up here to this 20 level. When you cross above 20 and you close at the high of the day or really near to it, this one probably is too much of a long upper shadow, but that one, and then over here, when you close at the high, so when you don't close at the high of the day, then you got more room to run. But when you close at the high of the day and you're above 20, that's a pretty decent sign. In fact, all the times that we've seen this past year, volatility is immediately reversed to the downside. And usually it's reversed at least to the prior day's low point, if not, in this case, through that low point. Let's see, over here, yeah. If not, in this case, through that low point. Or over here, you can see getting down almost about halfway to its prior day, and eventually getting down in a couple more days beyond that low point. So tomorrow's a really key day. Are we going to hold that support on the Fibonacci on the S&P? Are we going to come down from these VIX levels? Because if we do come down, then and that's actually my expectations that of what will happen. Then you'll see volatility come back down. We'll bounce off these lows from these extremes. We might not bounce up to 297.5 this week, but work our way back up towards that 292.5 level again over the next few days. Definitely within the realm of possibility. But if we break up and VIX takes off tomorrow, and this is the kind of setup that can lead to that. If the VIX takes off tomorrow and gets up to those high 115% levels, then we're going to be bearish for a while. And we might not head way down to, unbelievable lows, like 4 standard deviation lows that we saw in late 2018. We might not do that again because we weren't as complacent as we were heading into it as we were in October of 18. But it will be a while before a bullish trend gets going again, at least through September, and I would say through September and October to give you time for that market sentiment line to work its way down below 50. So what do you think? Do you agree or disagree with that assessment? There's a link popping out right there in the top right corner of your screen. Click on that link, hit either agree or disagree. If you click disagree, comment down below on what you're seeing that would suggest otherwise from what we came up with our outlook process here today. Of course, the biggest news of the day that's driving us is the yield curve inversion. For those who don't know what that is, I think everybody's pretty much heard about it. But for those who don't know what yield curve inversion is, longer term maturities on bonds should give you more interest than shorter term. Think about it at a bank, right? If you buy a 1 month CD versus a 5-year CD at a bank, that 5-year CD should have a higher interest payment for you than the 1 month CD should. So think of that too as our treasuries. A 10-year should have a higher yield than the 2-year. But today, the 2-year yield actually ramped up higher than the 10-year. So that's an inversion. That's pretty bearish. Usually it means the Fed has raised rates too much. Here, that's not the case. Here, it's the fact that long-term rates have fallen down so much. So this is a little unique in terms of like yield curve inversions being as bearish. Now, in my opinion, today the headline drove a lot of today's bearishness. Simply the headline, nothing more than that, because nothing changed from a fundamental outlook. In fact, if you take a look at the economic surprise index, it's really taken off. There's another tweet that I tweeted out right here that talks about this is a great article. So tweet that out there. It's from a I probably will say his name wrong if I try to pronounce it. But there you go. There's his name, and there's the site where their blog is. And you can see the Economic Surprise Index just finished its longest run ever of being below a negative 20. So today getting back up just a smidgen up above negative 20. 120, what is that? 120, pretty much 120 trading days. Being below that level. That's significant. I mean, early part of 2015, 2000 credit downgrade of 2011, and then this is the depth of the bear market, and of course in the middle of 2017 we had a deep run. So usually that's been, as you can see, not a bad thing for stocks, and usually is a bad thing for the safe haven areas, which have been so aggressively bullish here. As you know, again, from a linear regression standpoint, TLT still trades outside 3 standard deviations of its linear regression trend line, and same thing with gold. 3 standard deviations with really, really heavy volume, as you can see down there. Now, if I were to go out to a 5-year chart, you can see how big the volume was last week, and look how parabolic this move has been. In fact, if I were to look at TNX, just to kind of give you a context about how bullish the bond market is. Let me go to the rate of change chart here, and let's go back to TNX. The 10-year yield peaked and really started to come down here after November the 8th. Well, that's 191 days ago. So if I were to kind of show you where I got that number, draw a line from, nope, not from that day. There we go. From that day down here, you can see up at the top, these numbers here, is 191 bars ago. Okay, well, if I were to take a look at then the rate of change over 191 periods, right? 191 from close to close. So we are down today. Today, the yield is down over 50% of where it was 191 days ago. So right there, November the 8th. We close at 3.2%. We're down below 1.6. The yield since November the 8th of last year, the 10-year yield has been cut in half. Now, over that amount of time, according to this chart, just to kind of give you an idea of how significant of a decline that is for TNX, and this only goes back to 1997 is how much we got the data for. Just to kind of give you an idea, like here's 98. When the yields really declined quite a bit. We had the long-term capital management mess, and then the Fed dropped rates a few times, and you can see yields took off. At that point, it got down. Again, I have a line drawn at 50%, and you don't see it there. You don't see it anywhere over here either. At the end of that bear market, the bond market was just not that bullish during that recession. Here in 2009, over that long of a time frame, we've lost a third. The yield has dropped a third in its value, 34% at its worst. And then again, right around 33%, 36, 37% before QE2 came in. And then at the credit downgrade, we had lost about 50% of its value. So this is a significant decline in yields, which means a really, really bullish move in over that same period of time in bonds. I mean, bonds are up 30% over that time frame. 30% move in bonds. And if you look at gold, you can see a similar story. Not quite 30%, but you can see just how bullish it is, right? And it was this bullish again in 2016 when the dollar really started to decline, and the dollar really hasn't declined. You can see other periods of times when the dollar, coming off of QE1 and QE2 and heading into the downgrade, that gold really had a really good run during that period. being as bullish as it was, and now we're coming. That's a pretty decent move again from that right about November the 8th in this area right here of 2018. Decent run. So the safe haven trade is extremely overbought and extremely overextended in that bond market, as you saw. If I were to go back to the TNX now and do that same, its most recent decline started right here 22 days ago. So if I were to do a rate of change in a shorter time frame over the last 22 days and do this rate of change right here, then you can see again just how bearish we have been in the short term. Well, in the short term, that typically sets a low point. Another signal, again, considering again it's outside of 3 standard deviations on a 5-year chart and a 1-year chart. But you can see how getting this low in this short amount of time, dropping 25%, essentially a quarter of its value, the yield itself, in 22 days typically sets up for a rebound. If yields bounce back up here, most likely you'll see stocks bounce back up along with them. You would expect that to be the case. And again, why would I expect that to be the case? Because again, I think that today's move, especially today's move, and recent moves too, but especially today's move, has been driven by the inclusion of inverted yield curve in the headlines. That's caused a lot of bearishness, whereas the reality is, from an economic surprise standpoint here, we're actually doing a lot better than we have all throughout this year so far, moving back up to the upside from an economic surprise standpoint. If you take a look at the expectations for a rate cut going into the September meeting, obviously there's been some chatter about a surprise cut and maybe even a 50 basis point cut. If you look at the Analyze tab, the economic surprise, and we look at the 10-year note minus the Fed funds rate, and zoom in on what we're seeing here, see if it's been updated for today, and it hasn't been updated yet for today. So here we go. It was almost 50 basis points on the 12th. It hasn't been updated yet, but we've lost another about 5 basis points on the TNX in the last couple of days. So we're looking at over 50 basis points. So if they did it, in other words, if they did a 50 basis point cut, and there is a 21 only, which is, in my opinion, relatively low. It's much higher than it was yesterday. But there's a 21% chance we get a 50 basis point cut. That would just get that yield spread to zero, right? And if you look at by the end of December, the market's easily pricing in 2 cuts, about a 90% chance of 2, and about a 50% chance, a coin flip, of getting a third. So pretty decent odds. I would venture to guess that if the Fed wants to shake things up, and they've got the leeway to do it according to the bond market, if the Fed wants to shake things up and get the yield curve rising again, then they'll have to cut 50 basis points. There's precedent for them doing that, and they can easily do that. But doing only 25 won't get that yield spread between the 10-year and the Fed funds rate back above zero anytime soon. Of course, that's been impacting sectors. The worst performing sectors lately has been these interest rates. Well, the best performing has been the interest rate sensitive sectors. But you can see energy and financials have been just so poor. And you see other cyclical areas too leading the markets lower. But those two in particular are just getting hammered during this recent decline. In fact, if I were just to look at the last 2 weeks here, there's energy down 10% and financials down almost 8%, with the market down 5 3/4. And look at your interest rate sensitive areas. Again, just you can kind of see how overbought they are. Again, not on an absolute basis, but on a relative basis compared to the S&P 500. Again, you go back to that November 8th time frame of when yields really started to come down. So November the 8th of 2018 up until today's low on those yields, so on the daily chart. I mean, look at real estate's up 15% and utilities are up 10%. The market itself is still up 1%. as bullish as the bond market has been, it's a little surprising that we haven't been more bearish on the stock market. But as bullish as it's been, even the technology sector is still up 8%, whereas the energy and financials have just been hammered. And those will be the areas, if the yield spread were to tighten up, to look for opportunities again. And if we do continue to cycle down to the downside, you can see technology has got a lot of room to run to the downside. Let me show you this chart here. So again, the S&P is up 1% since that November 8th timeframe. When the U.S. bond market essentially started to catch up to the international bond market. Well, if I were to take a look at the foreign market comparison here, and then do the same thing, go back to that same November the 8th. So as soon as the bonds started their bull market here in the U.S., all right, since then until now, you can see where the S&P 500 is. Russia is kind of right there with it. Russia is down about 1% or so. You can't see it as well. Brazil is up 2.5%. You can see where Australia is, but look at where all these others. I mean, all the other foreign markets are down. The bigger companies in these foreign markets: China, UK, Germany, Japan. I mean, these are all the world's biggest economies out there, and they're all since that time down 10% roughly. 6.5% in Japan. Everything else 10% or more to the downside, and the S&P is up 1%. So, again, as bullish as the bond market's been, you'd expect the stock market to be a lot more bearish, but it's been the best alternative, despite the volatility. It's been the best alternative compared to its international counterparts. If I were to go back all the way to probably in this area where a lot of these a lot of these areas peaked. So it'd be July 3rd of 2019. To kind of give you a different perspective here on the U.S. as an alternative of 2019. Sorry. There we go. So there's India, Mexico, and India, Mexico, and China down here to the downside, 12%. The S&P is down 4.25%, but it's the best performing stock market in that time frame. So, and that's with some gains initially in Brazil that put it up, as well as Italy, and then they finally have caught back down and fallen below the U.S. So again, as bearish as we seem, things have been a lot more bearish in other places and in other sectors of the market that are kind of linked to these international areas, like materials outside the gold stocks and the energy market. For our trade idea of the day, I actually did a live video test with our premium subscribers at Market Scholars for our Market Outlook live video that we'll do at 3:30 Eastern. Allows us to put our trades on live. So I did a test for our premium subscribers. Remember, that's available for our plus subscribers, and probably will be available starting next week for everybody after I finish testing it this week with our premium subscribers there. But remember, you get the $99 a month plus subscription gets you access to our Market Outlook live videos where I can put on our trade ideas before the market closes. Cisco was one of those. It actually was a hedge trade similar to what we did with First Solar earlier in the week, but it also had earnings coming up, and you can see earnings so far. It's kind of a knee-jerk reaction. We're still trading right around a few bucks off of that level here. And the idea was even before that earnings, you can see that we were breaking below support, and again, technology had the room to pull back. All right, the interest rate sensitive areas won't pull back until the interest rates start to bounce again. And man, when interest rates bounce again, those are going to be some really overbought areas. But until then, if we continue to the downside, we need a hedge, like we talked about Wednesday. They can give us a small loss if we bounce off these lows, and which would be perfectly fine, taking that small loss. But if we continue to cycle lower, then we want really good reward to risk ratios on these. We took a look at selling the 45 put and buying the 47.5 put at the time. You can see at a pretty decent reward to risk ratio here. So here, let's go to let's duplicate this. Here, give me 1 second, and we'll duplicate this. create a duplicate order, and we'll analyze that. And just go to 1. All right. So to kind of give you an idea, it was a $53 risk at the time we put on the trade. That's all it cost, with a potential reward of $200. Knowing that if it did take off to the upside, then I'd be willing to lose half of that 53 bucks. So if I can get $25 risk for a $200 reward, that's a pretty decent reward to risk ratio, and that's where the position sizing comes in, right? Being able to take the full loss, but getting out earlier with just half of that, and giving us the ability to go all the way down. In this case, we'd have to go down to 45. So we're at 47.5 right now, and the stock is trading at 46 3/4. It's got to get below 45 to kind of make that trade work out. And you can see the bearish signals going into this earnings. We're all there. I mean, the vacuum of volume that we're starting to break into here. The next layer, in fact, we're actually breaking below that. If we break below that, then 45 comes into play, and that's kind of the idea, especially if the markets break their low points. You'll see that getting below the point of control will be really bearish for a stock like this. Then you look at its long-term chart, and it's been so bullish that now you can see getting to 46, below 47, is a significant break of its 200-day moving average. Would also be significantly bearish, and there's lots of momentum for this to continue to push to the downside before you even get a death cross on this stock. Not that I'm making a long-term trade. It's a short-term trade. It's a vertical spread. But you can see the bearish potential if we were to break down. If it doesn't break down, then I take a small loss. Great, fine. If it does break down, great hedge for the rest of my portfolio. As we start pulling off some of those bullish trades and start to get less bullish, looking for, as we break support and head towards more of a longer term pullback and not just an intermediate pullback. All right, well, that does it for today. As always, thank you very, very much for watching. I appreciate your time here today. It's a long video. You've heard from me now. I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our forums on marketscholars.com. Let's chat about it. What questions or comments do you have about what's going on? Let's keep the conversation going. Of course, you can also reply to anybody else's threads that they open up in the forums. Remember to subscribe to our YouTube channel, hit that thumbs up icon, and comment on our video. Follow me on Twitter for more content in between videos, and join our community at marketscholars.com. You can do it for free, as I showed you earlier, as well as on Facebook with our community that we've created there. Have a great rest of your evening, everybody, and we'll see you all next time.